Hello everyone and welcome to your Glassnode video report for week 36, 2022. Now we're going to be covering a bit of a dichotomy in the market at the moment. We're calling this the Bitcoin trial by fire, and this really refers to the short-term holder cohort. And what we're really seeing is a lot of the churn and the transaction activity and the stress is currently in the short-term holder cohort. On the longer term view, when we look at the macro picture, it's actually a bit more constructive. And really, this is kind of the characteristic of a later stage bear market, where the future starts looking just that little bit better, but we're not quite over the hill yet. We've still got to get through the actual final test. So we have seen a series of phases over the last 12 months of accumulation and distribution. And we're really going to characterize this using the accumulation trend score, which is a really powerful metric to just get a bit of a feeling for where the market is, what the sentiment was like at different times. And it really helps you set the stage for the various metrics we can use that follow to really describe what's going on. So we're going to look at this from a few angles. We'll start with that accumulation trend score, kind of setting the stage. We're also going to spend a bit of time looking at within that accumulation, who was actually doing it, with a bit of focus on whales and exchanges. We're also then going to kind of profile the macro long-term view. What are the HODLer cohort doing? And as a result of that analysis, we're going to then focus quite deeply on what's going on with the short-term holders, because that's really where a lot of the attention needs to be at this point in time. We're at that phase where a lot of people have recently accumulated in this 20,000 realm. And that means that as we test the lower bound of that, it becomes a point of stress. Do we still see that final capitulation and flush out, or have we seen really all of the worst put behind us? So as usual, please do give us a share and a subscribe for this channel. It does help us get to more people. And do pay attention when we get to the midsection of this video. There's a bunch of new content that we've put out recently that you may find useful, as well as a series of new international channels we have on Twitter and Telegram. So here we are in our week 36 dashboard. We're going to start with our price action, and you can see that we are languishing down here. We've been hovering just below that 20K level. We kind of pop our head back above it, and then we get slammed back down into the mid 19,000s. That said, we have been here for a series of weeks now. We've essentially been trading down through this range. We have not yet set a new local low, but sure, we are testing it. We are really hanging on by a thread. And as we covered last week, there's a lot of forces that are showing that when exit liquidity appears, the market seems to be taking it. Nevertheless, we are still hovering down here around 20K. So even though people are taking profit on any kind of rally, there's something underneath here that is holding things up. So now we're going to start exploring that through a number of lenses. Now, the accumulation trend score is a really powerful metric. You can use it for many things. You can look at it from more the micro scale, but you can also use it almost as a bit of a roadmap. What is going on and what is the sentiment? Now, what we're looking at here is really the zones since the all-time high. Here's our October and November all-time high in the last 12 months. And you can see these purple zones, that is areas of high accumulation. Now, what that means, some people get confused when we hear accumulation and distribution because there's always a buyer and a seller. Yes, that is true. Now, when we talk about accumulation in the context of the accumulation trend score, what it's looking at is, are the wallet balances increasing overall across the network? And the larger an entity is, and the more they're adding to their balance, the higher that score will be. Now, in between those who are distributing and accumulating is the exchanges. And this metric essentially has the exchanges as that black box in the middle. Coins get distributed from one party into the exchange, and they come out and get accumulated by somebody else. Now, naturally, the same coin that goes in may not be the same coin that comes out. And there's a time delay between those things. So the reason why you can have both accumulation and distribution at different times is because of that net flow of funds. So a really good metric to pair with this is actually looking at exchange net flows or exchange balances to see how that's moving as the final piece of the puzzle to look at accumulation. Now, these purple zones following the all-time high, we've kind of got four phases that happened over the last 12 months. There was those who saw that dip down from the all-time high and thought, well, that's it. That's my opportunity. We had very, very high scores up here. These are people who thought this was an opportune dip right before we punch up to 100K. They got 40K instead. So then during that period of time, we saw a phase of net distribution. This is when people started going, oh, hang on a second. Maybe this isn't just a dip. Maybe I'm actually on the wrong side of history right now. Now, what we then saw is a period of consolidation, which we then broke down from. This turned out to be a macro scale bear flag. We saw that distribution down into the lunar event, and following that lunar event, the psychology shifted. Note how we moved back into accumulation realm, even though we then sold off down to 20K. So you can see here that they're not necessarily one-to-one, but what I would implore that you look at with this tool is don't get hung up on, oh, look, it's purple, but it's sold off. No, what this signifies is a change in behavior. You're looking for the changing of the tide. What is it telling you that's deeper than just, oh, buying and selling up and down? It's a bit more nuanced than that. And those that can get beyond that wall of up means good, down means bad, once you kind of think about this is a phase shift, people saw the liquidations of Luna. They saw the forced selling of Three Arrows Capital. They saw a mass liquidation of the industry, and that became an opportunity set. Now, you can see here that obviously these folks who accumulated at the top here, as we sold off, you can now think about this as there's a bunch of people who are trapped up here. So that's going to create sell side. It's going to create headwinds on the way down. Now, where we are at the moment, we haven't yet really kind of hit that point where we're on the way back down, although it's certainly threatening to, and you can see how things have really lightened up. So potentially we may have a zone where there's a bunch of people who are yet again trapped if we get further downside. So you can use this to try and gauge where we are in the cycle, what are the potential risks, and then you can, once you've established a thesis using this tool, we can then dissect it using the further tools down this particular dashboard. Now, what I want to just highlight here, you saw that we had a bit of weakness during recent weeks. This is what we're seeing with these red zones, and note that the 10K whales, they're going pretty nuts. They are distributing at a fairly heavy rate. These are 10K plus entities. Now you can see that it's been fairly distributive, although there's a little bit of a sign of softening some of these smaller wallets, but overall, this distribution behavior aligns more or less with the weakening of what we had here. Now note that this same party, we had large whales and shrimp that were really driving that accumulation through that purple phase. So this is giving you a bit of a gauge that there's certainly some distribution by whales quite significantly. And what we're now going to do is actually unpick that a little bit more. So what we're looking at here is whale volume specifically to and from exchanges. And we classify whales here. Note that this is 10K. These are 1K. We're looking at whales here that have over 1,000 BTC. And these are only coins going in and out of exchanges. We only care about what transactions by whales in and out. And as you can see, their balance has more or less been flat since the bottom here. So this was a period of accumulation where this blue phase really stopped out. This also basically plateaued. So yes, they are net distributing of late, but it's also kind of just keeping it within the balance. Like the overall, over the last couple of months, there's not really been a significant change. On net, it's kind of flat. So it's giving you a bit of an idea here that overall the net balance, yes, has declined recently, but it's also within that kind of, we're not seeing a huge phase shift yet on the whale cohort. And arguably, this remains in a significant uptrend over recent months. And in fact, we've seen a little bit of a reprieve back to the upside, accumulating something on the order of about 8,000 BTC a month. But again, that's going to be a bit of a net balance. There's people who are clearly distributing within that cohort, as well as some who are adding. So we're kind of in a bit of a undecided phase at this point in time, something to pay attention to and something we'll be tracking over coming weeks. So now that we've established kind of the phase setup, what we can see is that short term, it looks a little bit dire. It may be a bit grim. So what I really want to answer here is let's split the market into two different cohorts. We've got our long-term holder cohort, the hodlers, the people who really do have high conviction with BTC. And then we have those who recently accumulated, they're short-term holders, they're traders, they're more in that liquid cohort. They're people who are willing to move coins around with the market as things play out. So let's start with the big picture. We care about the hodlers here. This is giving us a long-term view. Bitcoin in the future will be just fine, but it's going to be a process to get there. It's not immediate, and these bear markets take time to form. So we're looking at what does the long-term view look like, and can that tell us anything about the hodlers? Now, one of my favorite metrics is liveliness. It's very nuanced. It's a really, really powerful tool. We have a great Glassnode Academy entry for it, so I would recommend you check it out if you haven't seen it before. Liveliness is a very, very big picture metric, and it will trend higher when Coinday destruction is taking place. This is when people are spending coins that have been in cold storage for a long time, and you can see it typically rips higher during bull markets, right? We saw it here in 2020, 2021. It will then trade sideways as we kind of enter this transitionary period. You can see that 2019 was a capitulation into a rally and then back into a second capitulation. Overall, it was relatively sideways. Very strong downtrends, however, are net accumulation. The network overall is accumulating more time than is being destroyed. So this is what we typically see during bear markets. And you can see that Liveliness is in a downtrend. It's gone through this sideways period, not dissimilar to 2019. And we are now reverting back into a very, very strong downtrend. This is kind of signifying that second stage of the bear. We're getting to that phase where really the hodlers are the only ones left. There's the traders in the short term that are playing around with things, but hodlers really do dominate this space now, and we'll look at a couple of metrics to really highlight that. Now, really to capture that phase shift, this here is net distribution by the hodler cohort. This is overall net Coinday expenditure. We're seeing that time in the network is being destroyed. And you can see that following the May 2021 sell-off, this is yet another data point pointing to the fact that we probably started this bear market way back then, and the rally to all-time high was most likely somewhat of a bear market rally, which amazingly hit all-time highs. But what do you know? You can see that we shifted into this period of net overall hodler accumulation. These are the time insensitive hodlers, people who are willing to put coins away, rain, hail, or shine. I would consider myself in this cohort. I'm not overly phased about the price of Bitcoin. What I'm trying to look at here is what's going on. Are there more of me out there? Or am I seeing a lot more checkmates out there actually within the data, right? Do you see yourself within this data? And we can really see that the psychology shifted back here in May and June 2021. And we are in a period of net accumulation. What we are seeing is that the hodler cohort seem to be unfazed. They've become acclimatized. 20K is just another price to them. So it's giving us a bit more longer term prospects. It's actually looking not too bad in the long term. But remember, there's a path between here and the long term. And just to really wrap that up, if we take a sum, imagine this is in BTC space. We're looking at the rate of change of how many coins are flowing out of or into hodler wallets. Now, if we take a sum across all of this, there's a bit of going in, a lot of going out, a little bit going out, and you kind of sum all this together, this is what this metric is capturing. And what you can see is this is distribution. Think about this as the purging of hodler wallets. Hodlers are getting out of the system. They're taking profits into the bull. They're selling into the rally. They're taking whatever they can off the table. Then we get the phase shift. We get the May 2021 sell-off. Something changes. The market realizes, hey, we may well be back into a bear market, and the psychology shifts. And this here is a slow grind. Note how the explosion of spending, the expenditure, is a very, very quick process. Bull markets are full of fever, full of momentum. It takes a lot longer, almost twice as long, for that entire process to fully detox and recharge. But this metric is telling us that we have more or less fully detoxed and fully recharged from much of that bull market fever. We've essentially brought things back to equilibrium. So thus here at 20K, yes, the price is down, but it feels a lot more like an equilibrium. We've purged the tourists. All of the excess has been flushed out of the market, and Bitcoin has more or less returned back to a level of fundamental stability. Now, of course, price can be volatile, and at some point in time, we may get a correction to the downside and then also a correction to the upside. That would start to then re-establish new fundamentals. But right now, this is essentially signaling that we've kind of detoxed, and much of the bear market pain and all that psychological, the distribution of coins during the bull, we've essentially recharged from that. So now we're looking onto greener pastures and what comes next. Now, just as a very quick update, I do want to let you know what we're doing on Glassnode Forum. So Glassnode Forum is a great product that you'll find it's essentially a chat room forum where you can reach myself and the team. You can ask any questions if you're a Glassnode member. If you have queries about the data or you have a particular piece of analysis you want to share, we are more than happy to give feedback. And each week we're releasing what we're calling Glassnode Market Pulse. Now, these are a series of posts that we design, and they're really trying to help you. If you're a paying member for Glassnode, you're on advanced or a professional plan, we're really trying to help you understand the data and find that edge that you're looking for. So we put out things, we're looking at Bitcoin utility, so using all the transaction activity and overall momentum of flows to really characterize BTC. We're looking at lifespan, spent outputs, and spent volumes. So trying to understand the difference between a coin day, what is dormancy, what is ASOL, and actually using that time component to really understand the market better. Looking at things like means and medians of transaction volumes, whether it's exchange flows or transaction flows, understanding big and small entities. And most recently, we saw that some of the Bitcoin miners were having some issues with withdrawals. And what we can actually do is use that as an opportunity to use Workbench to try and understand how much hash rate is held by that particular mining pool and whether it changes over coming weeks. And really, the goal of Market Pulse is to show you how to use dashboards, how to use alerts, how to use Workbench, and just overall, how to get the most out of the Glassnode product. So very much trying to help you find the edge that you're looking for. And just before we get back into the action, we do have launched our Spanish, Portuguese, and Turkish channels. You'll find the official Telegrams and Twitter handles here, as well as our lead analysts for each language. So a big thanks to those guys for putting in all the hard work. And I do hope that you find those useful. And as always, let's get back to the action. So the charts that we were just looking at were what I would call the implied supply domain. We're looking at time, coin time, and the accumulation and destruction of it within the network as a proxy for supply. Coin time is fantastic for looking for that detox type behavior, and also when we're looking for older hands spending. That's really what we're looking for in those metrics. Now we're transitioning across and looking specifically at long-term holder supply. This is supply that we actually measure from the UTXO base. Now, this metric, as you can see, is pushing to, in fact, it is at all-time highs right now. Now, we use 155 days, about 5 months. The reason we use that for long-term, short-term threshold is because statistically speaking, when a coin has been dormant for 5 months, it's less likely to be spent. Most of the coins we see on a day-to-day are yet younger than 5 months, and the younger they are, the more likely they are to be spent. Now, if we go back 155 days, because really the coins that are migrating into long-term holder supply here right now were accumulated 5 months ago. Now, where is that? That's right up here, about 46K, just before we entered the lunar sell-off and then the final sell-off. So for the next couple of months, what we're going to watch is what happened during this process, because we know that this was quite soft from our accumulation trend score. But we know that after Lunar, so in about a month's time, after Lunar, and then following that, the sell-off down to 20K, this was a period of large-scale accumulation. We saw lots of investors buying that dip and seeing the flush out, the forced selling, and actually stacking sats during that time. So it would not surprise me, even though we're at an all-time high right now, that this metric will start to soften out as we come down this curve. But then in about a month's time, I would not be surprised if it doesn't start ripping higher again. So what that's going to tell us is two things. One, if it does start moving higher, it shows that people who accumulated during that lunar sell-off still hold on to their coins. They're unshaken and they are now long-term holders, statistically more likely to go the distance. If it doesn't start ticking higher, that tells us the exact opposite, that a large amount of the coins accumulated here have been distributed lower. They've been spent, they've panicked out. Now, that we can sit there and wait for a month and actually try and theorize about what will happen, but we can also look at a couple of other metrics. In orange, we have our illiquid supply, and in red, we have accumulation addresses. Now, accumulation addresses are wallets that have seen more than 2 transactions going in and have never spent anything. So illiquid supply are coins that have a very, very low history of spending on a supply basis, and accumulation addresses is kind of another data point. And what I want to highlight is from this point here, this is the threshold, remember, long-term holder supply takes 5 months before it starts to respond. Whereas these curves, they don't have the same probability associated with them, but they're also immediate. What happens during this process is what happened. So we don't have to wait for a 5-month lag. So they're a bit noisier in the fact that they can change over time, but you can see here the alignment between long-term holder supply, accumulation addresses, and illiquid supply. So there's a good chance that through this process, particularly as we enter this accumulation phase post-lunar, note how all of these really start to tick up. The gradient really climbs quite quickly. And it has stayed there. We haven't seen a big decline or a big drop off. So that's telling us that our first thesis, that we actually may get long-term holder supply continue to tick higher. And what that means, if we kind of push that forward, this price range still has a lot of those long-term holders. They're still here. And that's actually quite a good sign for the longer term. So more or less, the takeaway from this whole session so far has been that over the long term, the macro hodlers, they're unfazed. Overall, it looks quite constructive into the future, but it's going to take time to get there. And thus, we must now turn our attention to the short-term holders and the near term, where this starts to get really interesting. This is where the higher risk element is. The short-term holders in red are the more trigger happy. They're the most likely to spend in the face of volatility. And see this black line here? This is our current price, hovering just below 20K. And all of this supply that's currently sitting here, see all these red UTXOs? These are people who recently bought the dip. Now, a lot of them are now underwater. Imagine if we got downside. We get trigger happy clusters that may well spend and panic sell. But remember, we also have to factor in that we've been in this bear market now, if we argue since May 2021, for almost 18 months. The second side of that is that a lot of the folks who are still here and buying the dip when Lunar's collapsing and 3 arrows is blowing up, yes, they're short-term holders in terms of the time since their coin moved. But simultaneously, who's still around? So there's a higher probability the longer that bear markets go on that these short-term holders are in fact long-term holders. They just haven't reached that threshold yet. Now, we don't know that. And again, we get confidence over time. That's why long-term holder supply, it's delayed by 5 months in its response, but it gives us confidence of what's going on. And we mapped out that a huge amount of those coins are likely to actually transition into long-term holder supply. So we're building a bit of a case that there is probably the hodlers left. There's a reasonable chance that these coins here actually are held by those longer-term holders, but they've got to go through that gauntlet. And this is the gauntlet that we're really focusing on. Because in the short term, even a long-term holder who believes in Bitcoin's future, they may well trade up and down to get a better price. So we can still get that internal churn and volatility. So up to this point, we've established that these long-term holders, I mean, this guy's up here at 65K. They're not spending their coins. It's these guys that really are driving a lot of the price action at the moment. And that's where we're going to focus our attention from here on. Now, the supply in profit chart, in my opinion, is massively underappreciated. This is a really, really powerful metric. And the way to use this is actually the perfect example. We rallied up to 24K. Now, note the top here, we're about 64.2% of the supply is in profit. Now, in my view, the most important thing to look at with percent supply and profit is changes. During sharp price action, we essentially went from the top of the range at 24.5K down to the bottom of the range, let's just say at 20K for easy math. And we saw it decline from 64% down to 51%. So that's about 13%. The change in the percent supply and profit tells you how many coins are in this price range. How many coins last moved between 24.5K and 19K or 20K. It's showing you how many coins are in that zone. So we've got about 13% of the circulating supply that is in that zone. Now, that also shows that 13% of the supply sees 20K as a value zone. So that's the other way to think about these sharp changes in price. Look at how much the percent supply and profit changes. And that gives you a magnitude of how much accumulation has occurred in that particular price range. We're actually profiling out the supply, and we can use that to map out where are the clusters of cost bases, where if we drop down below it, are we going to have potential risk of sell side, and where are we actually seeing investor demand? If you think about it, if we then rally above to 24K, right? So imagine price goes to the same level, but percent supply and profit is 5% higher. Right? We rally up to the same price, but percent supply and profit is up 5%. That would mean that we actually have 5% additional supply from up here or back down in 20K has been redistributed here. More buyers stepped in, and then we got an even more powerful lift off. So that's really what we're looking for. We're looking for big swings in percent supply and profit, telling you a whole lot of people just went underwater if it goes down, or a whole lot of people are now back in profit, and that's generally a good sign for a reversal. So look for those powerful swings in percent supply and profit, particularly when we're chopping around. It will show you how much the supply is accumulating within that range. Now we can then zoom in and look at the percent supply and profit, or sorry, this is actually supply in loss held by short-term holders. Now you can see here that we're up. See, here's another one, a very, very big swing. This big swing higher of coins going into loss is essentially showing price dropping from 24K down here and picking up all of this supply. This massive swing higher in coins in loss is that price delta. So a huge proportion of this supply is held by those short-term holders. That's really that cohort. And that's why I highlighted above. They're really the entity that makes the most sense to be paying attention to. And they're the ones who are going to drive this price action in the near term. Now, coming to the end of this session, what I want to highlight is what we called in the article plunge protection, which is basically looking at where is the fundamental support below us. Let's also prepare for these scenarios where things really do break. And if we do get any downside price action, where is the fundamental support levels? And in this particular instance, we have two models which are both aligned and basically hovering at the same price between 17K and 17.5K. Those two models are the balance price, which we have here in orange. And what that's mapping out is the realized price, which think about that like the on-chain volume weighted price. Where's all the volume transacted on chain? And the difference between that and the transfer price, which is the time weighted. We're looking at coin day destruction valued by USD. So think about this, it's the volume weighted, that basically the difference between the volume and the time weighted. So we're really looking for where is that transactional level? Where have we seen the supply on a time and a volume basis get transferred? Where is that cost basis? The other one we have is the difficulty regression price. This is kind of the all-in estimate sustaining price. Look at all of the mining equipment, all of the different power contracts. Some are in China, some are in America, some are in Kazakhstan. We have miners all over the place. S9s, S19s, different models. Some guy who's running off solar panels, some guys running off gas flaring. All of that information gets baked into one number, difficulty. So what we do is we take a log-log regression between difficulty and market cap, and it helps us estimate the cost of production. Now, there's been a number of studies done over recent years where people have been trying to estimate it using different power rates and estimating using different rigs. And recently there was a bunch of these studies that came out and they were all hovering around the same price, something around 17.5K. Now, we also caught the wick on both of these models back here, right? As we had that sell-off down below 20K for the first time. So there is a fundamental support level down there at 17K. Again, these things are models. Models can break. But what we're looking at here is we've tried to establish that there's a short-term holder cohort. They're a little bit under stress. They're the most trigger happy. We do happen to have support both at a technical level, just simply the last support level that we had, or the bottom of the wick, and two fundamental models, one derived from on-chain transactor activity and the other one derived from mining. And further to that, we can also see that most of the exuberance has been flushed out. The market's seen a detox. So we're in this realm where the hodlers are starting to dictate. They're starting to make more of a say. We've seen all the speculation purged out of the system. We're heading closer towards equilibrium. So it just gives you a bit of a model in how you can start assessing this market moving forward. And really, with the macro economy the way it is, be prepared for all things, but we can really start to understand what's happening using this data. We'll be tracking this over coming weeks so we can really understand what happens and why. So thank you everyone for tuning in. Hopefully you found that useful, trying to break down that longer term, which looks quite constructive, and the shorter term, which can get a little bit hairy. But we do have a couple of models that can help us try and track what's going on. And if we do break those support levels, then you start thinking about, what is the next phase down. So this is the metric of the week, looking at this difficulty regression model and the balanced price. It's very uncommon that we see this kind of confluence of models from two different angles sitting there. So do check those out on the dashboard, and I will see you next week. Cheers.